Welcome to this BNamericas Oil and Gas 2020 CapEx webinar. My name is Michael Place and I'm your host this morning. I'm joined by my energy sector colleague, Cristobal Riego. Good morning, Chris.
Good morning, Michael. Thank you for having me, and I hope everyone listening is doing well.
We understand that this is a very difficult time for everybody. We hope that you are all in good health and taking good care, and we appreciate you taking the time to join us this morning, or this afternoon or evening for those in different time zones. We're just going to pause for a few minutes to allow more people to connect. We will be with you shortly. Hello, everyone. Thanks again for taking your time to join us for today's BNamericas Oil and Gas CapEx webinar. We're acutely aware that the global energy sector is going through a tough time, a time of great uncertainty caused by COVID-19. Latin America has been no exception. The aim of this webinar is to provide an analysis of the effects of the pandemic on capital expenditures among oil and gas operators in the region, and also to look at some of the actions of the larger state-controlled companies, as well as governments and regulators, to soften the impact of the crisis. All participants are in listen-only mode and can submit questions in the panel, which should be appearing on the right-hand side of your screen. We will endeavour to answer all questions at the end of the presentation, and if there are any that we're unable to answer because of time constraints, we'll provide a response by email. You'll be able to see our email address at the end of the presentation. So I want to start this by providing a general overview of the market as it stands and essentially go over some of the key triggers for the widespread CapEx cuts among operators in Latin America and indeed all over the world. So Brent crude fell as low as $16 a barrel on April 21, which is the lowest level since 1999. WTI prices went even further. They went into negative territory for the first time in their history. So that showed that an end to the Saudi Arabia-Russia price war on April 12 didn't have the impact that many producers were hoping for, and it proved beyond any doubt, if there was any at all, that unlike the previous industry downturn from 2014 to 16, the current crisis is overwhelmingly driven by demand, or a lack thereof. So a new report from the International Energy Agency predicts a 6% decline in global energy demand in 2020, which is the largest ever drop in absolute terms, and 7 times greater than the fall that coincided with the 2008 global financial crisis. The IEA report found that each month of the worldwide lockdown at levels seen in April would reduce annual global energy demand by about 1.5%. BNamericas believes that Brent will average between $30 a barrel and $40 a barrel in 2020. That figure is obviously helped by the fact that the median price in the first quarter was $50 a barrel, and we see prices rebounding to possibly the low 40s or the mid 40s by the end of the year. So 9 of the biggest oil majors active in Latin America are cutting collective global capital expenditure by 23% in 2020 compared to 2019. All have reduced their capex since the World Health Organization declared COVID-19 a pandemic in early March. Now, these majors, which don't obviously include the Latin American national oil companies, are Exxon Mobil, Shell, Chevron, Total, BP, Equinor, Eni, Repsol, and Occidental Petroleum. The combined 2020 capex guidance of the 9 biggest majors active in Latin America is $106.4 billion. Now, we believe this overall figure to be somewhat optimistic, and that further reductions will be made in the coming weeks and months, given the reports in recent days and weeks about field shut-ins and the latest rig and production data. So apart from Occidental, which had some financial difficulties before the coronavirus pandemic hit, the biggest cut in percentage terms this year will be from Exxon Mobil, which has forecast a 26% reduction this year from $31.1 billion to $23 billion. Now, it's important to note that Exxon Mobil was the last of these 9 companies to adjust its guidance. That was in early April. So maybe it's the only one to really fully consider the severity of the pandemic. Chevron's March cuts were just behind Exxon in percentage terms, with their $5 billion reduction representing a 24% year-on-year decline. Most of the other companies reduced their capital spending targets by between 15 and 20%. So only 14% of the 28 companies that we studied plan to spend more in 2020 than they did in 2019. 2 of these are state oil companies, being Pemex and YPFB from Bolivia. Now, in the past few days, Pemex has gone ahead and cut its capex forecast by $1.8 billion, which unfortunately was just after we produced this graph. So in fact, the overall expected spend of NOCs this year is $33.8 billion, which represents a 6.5% decrease compared to last year. But even with this revised figure, Pemex still plans to increase its capital outlay by 9% year on year, which is well against the trend of the region. So now Cristobal will talk, well, not yet, sorry. Ahead, a bit further on, Cristobal will talk more about Pemex's plans for the year in terms of capex and operations. So again, please keep in mind that the 2020 capex forecast for Pemex in this graph is in fact $14.9 billion and not $16.7 billion, which appears in the graph. So Petrobras, YPF, Ecopetrol, and Petroamazonas will reduce capex by $3.7 billion collectively. Petrobras alone has cut $2.2 billion from its guidance, and I'll go into some more detail about that in a minute. Ecopetrol has been more bullish than most in its outlook, with a midpoint 2020 guidance that is only around 13% below last year's total. And the figure there for Petroamazonas is an estimate based on spending reported by the company in January and February, which was obviously before the pandemic hit. So for that reason, that forecast is now considered highly optimistic. As a group, the 6 NOCs profiled spent $36.15 billion in 2019. This equates to 86% of their planned capex of $41.92 billion as outlined in the BNamericas Oil and Gas Capex 2019 report. While most of the operator spending was roughly in line with guidance, the standout case of failed capital execution in 2019 was Petrobras, which spent just 2/3 of what it had planned to outlay. Petrobras' guidance for 2020 is 79% of its 2019 realised spending and just half or 53% of what it had hoped to execute in 2019. So the 13 mid-sized and smaller operators that were included in our research are targeting a 6% capex reduction this year compared to last. 5 of them have provided guidance that would indicate a spending increase, nearly offsetting reductions by the others. So Colombia provides a study in contrast, given its diversity of stakeholders and also its resource characteristics. Canacol, for example, seems to have been relatively unscathed by the oil price freefall because of its focus on natural gas and firm long-term contracts which guarantee revenue streams. But there are plenty of others that have significantly cut capex, including Gran Tierra, which plans to spend just 18% of last year's amount. Other Colombia-focused companies to significantly cut their capex this year are Frontera, Parex, and to a lesser extent, Geopark. Now we're going to dig a little bit deeper into the capex plans of some of the larger national oil companies in Latin America. So now I'm going to hand things over to Cristobal, who will talk about Pemex and YPF, and then I'll provide a rundown of Petrobras and Ecopetrol. Chris, it's all yours.
Thanks, Michael. So we're talking about Pemex first. Pemex is planning a capex cut of 45.5 billion pesos or $1.9 billion this year, as Michael discussed earlier. The bulk of these cuts will come via $1.67 billion in cuts from exploration and production arm, PEP. Instead of the $16.7 billion the company was expected to spend earlier this year, it now plans expenses of $14.8 billion. The company has not tied this cut to specific projects yet. However, it has played recently up its output from 7 new fields that it will newly focus on. These are Quesqui, Ixachi, Chiquin, Joc, Cheyecbal, Mulach, and Tlacame, where it will focus new activity. So far, Pemex has a total of 11 wells at those fields. This new focus signals the company is scaling back plans from January 2020 to add 15 more fields to its original priority list that encompass 20 fields. It also suggests we may see some delays at some or most of the original 20 priority fields, which were announced in 2019 and were expected to be the main focus for the company in 2020. The government announced tax reductions of $2.7 billion for Pemex that will be rolled out during the year. And Pemex has already lightened its tax obligations by $670,000 in March and is expected to pay reduced taxes each month this year from April to December. The government was originally expected to inject the NOC with between $2 billion and $2.6 billion in cash this year to help the company stay afloat. But given the scale of Pemex losses in Q1, this sum is likely to increase as the year keeps going. So Pemex is in a difficult financial situation. We know it is sitting on over $100 billion in debt, and previously had aggressive spending and exploration plans for 2020 in a bid to increase its oil output over the next few years. Last year was the worst year in the company's history in terms of earnings. In the first quarter of this year, the NOC lost 562 billion pesos, or approximately $24 billion in the first quarter, due to setbacks related to harsh macroeconomic factors, a depressed oil demand, and especially the weakening of the peso against the dollar earlier this year, which magnified the company's losses. Now moving on to YPF, the Argentine NOC. So before the full extent of the COVID-19 pandemic was understood, this is in late March, state-controlled Argentine oil and gas company YPF was expected to invest $2.8 billion in the country in 2020, which represents a drop of 20% compared to 2019 investments of $3.5 billion. The company originally was planning to scale up investments both in 2019 and in 2020, but local conditions changed these plans before the pandemic and the demand crisis. This decrease will be or was expected to reflect in less exploratory and pilot projects during 2020 and much lower gas production, which was expected to fall by 8% before the pandemic, from an average production of 40 million cubic meters per day in 2019. So the company at the end of last year and beginning of this year was already struggling with a depressed local gas market and a freeze on the price of crude oil and fuels that was implemented and then lifted last year. Lockdown measures designed to combat the spread of COVID-19 have reduced local demand in Argentina for fuels by between 50 and 70%, depending on the month, with oil stocks accumulating across the production chain. YPF has dramatically reduced output at its refineries and was forced to shut down 50% of its wells at Star and Conventional Block Loma Campana in the Vaca Muerta Unconventional Formation, which will obviously impact its production forecast for the rest of the year. While the company is looking at exporting options, it is likely it will need to shut down further production and reduce its investments for the rest of the year. The company faces a $1 billion maturity next year, which will force it to keep a strong cash flow, as refinancing options are very limited in Argentina due to the country's tight financial conditions. As you may know, Argentina is in the middle of attempting to restructure $65 billion in foreign debt commitments with international bondholders. YPF will postpone the de-risking of new activity clusters in unconventional formation Vaca Muerta and was originally expected to focus on 3 of its most developed blocks, which are also the ones with lower production cost: Loma Campana, La Amarga Chica, and Bandurria Sur. This, of course, is now conditioned on whether demand for fuels recover in Argentina as lockdown measures are progressively lifted throughout the year. So that's those YPF and Pemex. Back to you, Michael.
Thank you, Chris. So now a little bit about Petrobras, the Brazilian NOC. So Petrobras reduced its capex guidance to $8.5 billion in March, which represents a 20.5% decrease compared to 2019. The 2020 crude oil production target was cut by 200,000 barrels a day, which is around 6% of the total, as the price crash worsened in early April. However, the reduction was revised to 180,000 barrels a day for the month of April, amid higher than expected demand for its exports. So April output is expected to have averaged 2.26 million barrels of crude oil a day. The utilization rates at refineries has reached 79% after having been cut to 60%. The company has prioritized bunker fuel, for which demand has remained robust throughout the COVID-19 pandemic. Petrobras has benefited from international regulations introduced early this year that lowered the maximum allowed sulfur content of bunker fuels. This is because a large percentage of the oil produced by Petrobras is naturally low in sulfur, meaning it's ideal for bunker fuel production. First quarter output of bunker and other fuel oils by Petrobras rose 18.5% from the previous quarter and almost 50% year on year during Q1. The company has maintained plans for a late June start to production on its P70 unit at the pre-salt Atapu field in the Santos Basin. In addition, output has been ramped up on the P68, P67, P76 and P77 platforms that came on stream throughout 2019. So moving on to Colombia's state-controlled oil company Ecopetrol. The latest CapEx guidance for Ecopetrol has a midpoint of $3.8 billion US for 2020 compared to $4.4 billion US of realized CapEx last year. The company has so far maintained its 2020 crude output target of 745,000 to 760,000 barrels of oil equivalent a day. That's despite the fact that Deputy Energy Minister Diego Mesa said last week that overall domestic production could fall by 130,000 barrels a day this year due to field shutdowns. Now, we believe that most of the output cuts will be made by independent firms whose break-even prices are up to $20 per barrel higher than those of Ecopetrol, which can remain profitable with prices as low as $30 a barrel, or at least breaking even at $30 a barrel. From an exploration standpoint, Ecopetrol plans to boost reserves through new drilling campaigns, particularly in the Llanos Basin in the Department of Casanare. The company set a target of 30 exploration wells for the year, and although this hasn't officially changed, we believe that's an optimistic number given the current environment. The third cycle of the permanent offer process, also known as PPAA, is due to be completed later this year, having been postponed in recent days because of the market uncertainty. Now, the success of the auction will hinge largely, obviously, on the market's ability to quickly recover. We believe that if prices remain below 35 or 45 or 40 US dollars a barrel, that the bidding process could be postponed again to 2021. How is Latin America easing the impact on operators? We've seen in recent weeks quite a few measures introduced by regulators and governments across the region. In Brazil, operators have been granted 9 additional months to conclude exploration activities by the regulator ANP. ANP has considered, or is also considering requests to deactivate 65,000 barrels a day at 16 offshore and 12 onshore fields. Petrobras said in April that it expected to cut output by 200,000 barrels a day, as I mentioned previously. That was reduced or lowered to 180,000 barrels a day for the month of April, given what I mentioned about bunker fuel and increased demand for its fuels in general. So we believe that as long as that high demand for Petrobras exports continues, then possibly that output cut of 200,000 barrels a day won't be so high. It could be, 180,000 barrels a day, or even less than that. We've heard no more from Petrobras, but we expect some more information about production and its plans for the rest of the year in the coming weeks. Colombia is extending deadlines for payments of economic rights by block operators. ANH, the regulator, oil and gas regulator, as I mentioned a minute ago, has postponed the bidding schedule for the PPAA schedule, rights auction, and has also made deferrals for deadlines for exploration obligations. Operators have been given freedom to redirect investments in stalled exploration projects to other upstream activities, which is seen as being a very important measure in recent weeks. And also there has been a fast tracking of rebates on value-added tax and an easing of rules related to letters of credit for block commitments. So in fact, in Colombia, we're seeing quite a few measures, possibly more than in any other country in the region, in terms of steps taken by the government and the regulator ANH to help operators through the crisis. So I'm going to pass it on to Chris now, who'll talk a little bit about Mexico, Argentina, and Bolivia. Chris.
Thanks, Michael. So in Mexico, we've seen the temporary suspension of terms and deadlines for E&P projects, which could be extended beyond May 30. So these were introduced at the end of March. Dates were delayed at the end of March for 1 month to the end of April, and regulator CNH has added an extra month to that, meaning suspensions would end at the end of May. And then we expect for as long as this crisis continues, these extensions are likely to also continue and keep extending the deadline. We've also seen, as we talked earlier, tax reductions of $65 billion for Pemex over the course of 2020. In terms of Argentina, we've seen two policies that we could characterize as negative. So for one part, the devaluation of the peso has made it very difficult for the government to cover the incentive plan known as Plan Gas, an incentive plan for certain unconventional blocks of natural gas production. So the budget that was assigned to them has lost weight because of the devaluation of the peso, and the government has also suspended those payments of those subsidies in the first quarter of the year. So it is unclear what will happen on that front as of now. We've also seen the postponement of a tender for the first section of the Tratayensa-Liqueló pipeline, which is also known as the Vaca Muerta pipeline. This is a very important pipeline connecting Vaca Muerta with the Argentine coast and then with the cities of Buenos Aires and Rosario. This was seen as a vital project for the ramp up of conventional gas production in Argentina and in Vaca Muerta. This tender was already postponed last year, and it was postponed again because the business conditions currently don't allow for its development. And then we are seeing a support measure for the industry, which is the plan to set a minimum oil reference price for local producers, which right now the discussion hovers around the $45 per barrel, but this could be higher, lower, depending on the situation and the point of the measure is taken. But this measure, of course, has pros and cons. For some local players, it may be a boon, but it has been enacted in the past by previous administrations, and the impact has not always been all positive. So it's a sort of a mixed message there, but it is likely to happen later this year. Then in Bolivia, the government is weighing up whether to prioritize local fuel production or ramp up imports. It is also looking at export opportunities in neighboring countries such as Argentina and Brazil to allocate excess gas production. So that's for Bolivia. So back to you, Michael.
Thank you very much for that, Chris. Okay, so we're going to move on to the Q&A section now. We'll just pause for a minute or two to look at the questions and to prepare some responses. We'll be with you shortly. Okay, so we're going to start. We've had questions been coming in thick and fast since the webinar began. Thank you for participating, for sending us these questions. We've had some of our fellow energy reporters look at the questions and prepare some responses. We're going to start with a question from Brazil. Which Petrobras assets are for sale, and has the company's divestment process been affected by the COVID-19 pandemic? So Gabriela Ruddy, our correspondent in Rio, has prepared a response. Thank you, Gabriela. She says that Petrobras is holding a $20 to $30 billion US asset sale program in order to focus on deep water E&P activities, obviously particularly with a strong focus on pre-salt. The sale catalogue includes stakes in mature fields as well as a selection of newer onshore areas and shallow water blocks. The company is also selling interest in pipeline and gas distribution subsidiaries, 8 refineries, wind power plants, and also biofuel assets. Now, according to Gabriela, there is an expectation that the company will sell its thermoelectric power plants, but we're still waiting for confirmation on that. Petrobras has made a point, I think it's important to say, has made a point of saying that the sales process will continue as planned despite the current market uncertainty, with only minor changes if needed because of the crisis. We've seen the company postpone the bidding deadlines for its 8 refineries, and it's also pushed back the cutoff date for the qualifying phase of its gas petro sale. I think there was an update on that yesterday. So we have another question from Brazil. Could you provide more information about Brazil's plans to open up the natural gas market for private investors? Okay, so we have a response again from Gabriela, who says that although current market uncertainty has led to the rescheduling of some processes, such as the public tender to contract transport capacity for the Bolivia to Brazil pipeline, the gas pole pipeline, it is not expected to have significant impacts on Brazil's Novo Mercado de Gás new gas market program. Petrobras has said it's continuing with the processes to sell its remaining interests in its gas transport and distribution units, as well as giving private operators the chance to use gas capacity which it controls, and also gas processing plants. So these initiatives are expected to spark competition in the long monopolised gas market, which in turn will reduce prices and benefit local industries, in addition to paving the way for additional investments in pre-salt natural gas production, which still hasn't obviously even gone near its potential. Thank you for that, Gabriela. So we have a question regarding Colombia. When are the first fracking pilot projects likely to begin in Colombia? Okay, so the Colombian government has said that the fracking pilots are a major priority. Unconventional fields are seen as being something of a lifeline to the country's hopes of extending the longevity of its reserves, which stand at around 6 years, a little bit over 6 years at current production rates. Until now, we've seen a number of regulations published related to general guidelines for operators, and also contractual criteria related to unconventional drilling. Now, we're awaiting the publication of technical requirements and also environmental protocols, which are expected to be finalised soon, possibly by mid-year. There was talk within the local industry that fracking pilots would be able to begin this year, but we see that as being very optimistic, and that early 2021 is now a more likely scenario for that. So thank you for that Colombia question. We have a question about Suriname, so I might pass that on to Chris.
Okay, thanks, Michael. So we've asked David Casillas, he's our Suriname expert. The question is, Suriname state-owned company Statoil recently raised nearly $200 million on the Dutch Caribbean Securities Exchange to cover the development of offshore discoveries. What other financing plans that the NOC have? And David's answer is that the company has said that several financing options are being looked at, including a share issue and international bonds listed in London or New York. Statoil is also preparing for an IPO, but again, much of this may be retooled due to the current and near-term operating environment. We've also had 2 very similar questions about Pemex. One is, do you expect Pemex to further cut their CapEx for 2020 given the new developments in their financial situation? The other is, did you consider whether the Pemex has implementation capacity to execute the announced investment? So I've asked Sean Goforth, he's our Mexico expert, and he says there is definitely uncertainty over Pemex's ability to implement the changes because of the dueling political demands by AMLO that the company lift output at all costs and the market and financial realities of it being unable to produce oil in a profitable way at these price levels. So the cuts the firm has announced for 2020 do not adapt to it breaking even, which the company leadership appears to concede when noting that they are eyeing zero net debt by end of 2021. For now, the cuts it can actually implement amount to abandonment of at least 10 of its 20 priority fields and possibly 12 of them, which will also hurt its production outlook going forward. Then we have a question about Argentina. So how is the crisis affecting small and mid-sized independent players in Vaca Muerta? So the extent of the impact will of course depend on the company we're talking about. But a good rule of thumb is that the more flexibility a company has in terms of contracts and its investment commitments, the better it will be able to navigate the ongoing crisis. So companies are looking to aggressively slash investment this year, shut down the wells that they feel they can open again easily, to wait for better price signals and secure storage solutions for May and June production, which they are already, many companies, they have no way to allocate this production efficiently. So we have, for example, the example of Vista Oil, one of the main mid-sized players in Vaca Muerta. This company decided to shut down its highly production and conventional pads in Bajada del Palo Este, betting it can recover them easily down the line, but kept its conventional production. So while Vista had spent $75 million in its plan to ramp up unconventional production in the first quarter, its plans are to spend only $25 million over the rest of the year, trying to save cash to ramp up production as soon as prices recover, probably next year. So CapEx will be less than half its expected guidance of $200 million for 2020, so that should give an idea of the kind of impact it is having on investment. The situation on the ground in Argentina is of course very fluid, and every company will have its own response. But the shale industry is definitely entering survival mode, where players will hunker down until the price environment recovers, at least in oil. So we have another question about Vaca Muerta. Is there an opportunity for Bolivian natural gas due to the high production cost of Vaca Muerta? So this is an interesting question because not only Vaca Muerta gas is being hurt by high production costs, it's also being hurt by the lack of transport capacity. So for example, in Argentina's north, there are in winter, when demand picks up in Argentina, there are problems to get enough gas to travel from Vaca Muerta to the north of the country, and that's where Bolivia has the better access. The same can be said for Brazil. Argentina had plans to ramp up gas production and export gas to the south of Brazil, but without the transport capacity, these plans are going to be delayed. The plans to expand transport capacity are also going to be delayed by the current environment. And so Bolivia, that has an existing infrastructure that's stronger in that sense, may have a big opportunity to expand its influence in those terms. Those are the questions I am seeing about Argentina and Mexico. So Michael, back to you.
Right, thank you, Chris. We have a question about Colombia. Ecopetrol is Ecopetrol planning to maintain the international business? Well, as we know, Ecopetrol in recent years has had a stronger focus on trying to boost reserves and obviously eventually production in the US and also in Brazil. Obviously, the Permian Basin, they've got assets there, and they've got assets in the pre-salt area of Brazil as well. Now, most of those projects are, all those projects, in the early exploration phase. We believe there will be a natural delay in those projects because of CapEx cuts. I think early stage exploration projects are among the first to suffer because of those CapEx cuts across the board. I think it will depend largely on how the company is able to ride out the crisis, given that the international business, especially Brazil and the Permian Basin, have been such a big part of of Ecopetrol's plans over the past year or two, I don't think there will be any rush to be making a decision on halting their international plans. So it's important to remember that Ecopetrol is one of the best positioned companies in terms of how it's able to cope from an operational standpoint. The break-even price of its oil is around the $30 mark a barrel, which compares very favorably to other major oil companies in Latin America. So that in itself holds the company in good stead and indicates that it might be able to ride out this crisis better than others. So time will tell, but in the short term, there've been no indications that Ecopetrol might halt its plans to expand its international business. So just looking to see if there are any other questions.
Mike, we have another question about Pemex.
Right.
So the question is, in order to start fixing Pemex, so to say, what are the first steps that we would consider the company should take? So I asked Sean about this, and he said last year the company took a good first step in refinancing a portion of its debt, which is a big part of why the company is so burdened right now. So this was a first step, but the company has still been downgraded to junk status on its debt by 2 of the 3 major credit rating agencies. So Sean said operationally they have to find a way to abandon most, if not all, of the 20 priority fields. That would be a good first step. Because the vast majority of these fields have break-even points about $35 a barrel. So they will almost definitely become unprofitable in the short term in this scenario. And of course, if the company walks away from these fields, it would mean that it will not be able to lift its output as it had planned before. So output would decline, and that would have other consequences. But that would be a good initiative if the company aims to survive this very complicated situation.
Thank you, Chris, for that response. We're going to leave it at that. We're running out of time, so our apologies to those who didn't have their questions answered. You won't be forgotten. Please send your questions, any of those that were not responded, to the email address which is appearing on your screen, and our team will respond to you shortly. Also, we're going to be sending this presentation to our subscribers very soon, so keep your eye out on that. So thank you very much for taking the time to participate in this webinar. Please take care during this difficult time and be sure that more than ever, BNamericas is committed to providing you with all of the latest news, market insights, project and company profiles, and data across 11 industries in Latin America. On behalf of everybody at BNamericas, thank you and goodbye.